right, welcome to tonight's live stream where we have a really excellent show for you because we're going to be discussing the common mistakes that we often see that lead to thousands, sometimes potentially tens of thousands of dollars in costs, sometimes explicit and other times hidden. So with me tonight, I have Miss Lizzie Krogh, certified financial planner professional, and also Mr. Ed Rossi, another certified financial planner professional. All three of us also certified private wealth advisors, CPWAs.
Correct.
Correct, yep.
So only three in the firm. So
Yep.
that's you know, go team. So tonight's going to be really interesting because our de facto leader when it comes to YouTube production and video has thrown his back out. So Eric Calderon, he's not here tonight. So instead of having the multi-angle approach and perfect sound quality, we're kind of winging it. The team came together. They made this work. So we had some pressure to cancel, but I said, nope, the show must go on because we have some good content to deliver. So very excited about this tonight. If at any point there are issues, just simply type them in the chat and we'll do the best that we can. But we think we have it set up pretty well. We think it's going to come off excellent tonight. So one of the things that I like most about this live stream is because we see these things throughout our career, I don't want to say hundreds and hundreds of times, but
it feels like it.
It feels like it, over the years. And some of them are so avoidable, but a lot of times they're hidden, right? So much of what we do on our side from retirement planning is making trade-offs visible. Right? Every decision that you make, it interacts not only with other decisions, but it interacts with the tax code. And so raising those trade-offs and making them visible so our clients can make better decisions is a large part of what we do. So oftentimes people are making decisions, and sometimes, yeah, they're boneheaded decisions and they just shouldn't have done them. But other times they're very good decisions made by any means with a reasonable basis, trying to serve a particular goal or objective, but they don't have the awareness of the interactions that those decisions have with one another and also what they have with the tax code. So that's what we're going to get into tonight, and it's going to be very educational. It's going to be very, very powerful, I think, for many of you. So a couple house cleaning items before we get into the very first one. Okay, so I got a couple sounds are low, turn up the volume. So everyone at home, please just make sure your volume is turned up. We've had this issue before. And then we'll do our best to talk a little bit louder, and they're going to work on it behind the scenes. So housekeeping items. So we're going to do a giveaway tonight to your favorite restaurant. So in the chat, Corinne from the marketing team is going to put a number that you can text and also, I believe, a link that you can click to receive our Retirement Success Plan guide. If you do that, you're going to enter into a chance to win the giveaway for $100 to your favorite restaurant. So good luck tonight. We're going to do two of those. The first one will be halfway through. The last one will be near the end, which should be about an hour from now. So Ed, how you doing?
Doing good. Thanks for having me back.
Good, good. When was the last time you were here?
I didn't count the days this time around.
It's
been a while.
Marked off in your calendar?
No, not this time. I'm organized, but I'm not that organized.
Lizzie, how are you?
I'm good. How are you doing?
Did you have them marked off in your calendar?
I did. I was counting down. Yeah,
and?
exactly. So I could be featured next to Ed, who's my personal hero. So.
No. Let's not go there, folks. Troy, continue.
Ed blushes easily, so. Yeah. All right, so.
His lights aren't bright enough.
Okay, so we were talking kind of before this, getting prepared, and Ed, you brought up an interesting one. You kind of call it penny wise and I assume pound foolish. Mm-hmm. Tell us about that one, common mistakes or a mistake that you have seen that someone made that ultimately cost them a decent amount of money.
Yeah, it happens more than I care to admit, but it does happen via my personal experience working with a lot of clients. It was a new client that came on board, very interested in tax planning, reducing those future tax liabilities associated with required minimum distributions, which were way down the road. At the same time, and it made perfect sense, he didn't want to let us manage all of his assets again, and that is more than fine. I hear that all the time. I affectionately say, hey, keep some certain percentage, call it your mad money. You know, I hope you triple it, I hope you quadruple it, but I know that, God forbid, if you turn it to zero, you're still going to be okay. And so he chose to do that. We went through a very comprehensive tax analysis for the current year, set a target to do a particular amount of Roth conversions that year. Fast forward, that was probably April or May of that particular year. Fast forward to the following year, we get back the tax return, tax rates are much higher than what we estimated. Tax bill much higher than estimated, and everything else that kind of falls into place from that. I want to say that it even affected Medicare premiums and everything that we talk about on this program. So naturally, my curiosity went up. You know, I get the call, of course, you know, hey, you estimated this much and it came back at this much. I'm like, okay, well, I need to see that tax return. And we put it up side by side. He decided with the assets that he was managing to make some trades towards the end of the year. Complete, because it was back in April. So what is that, 7, 8 months? He decides that, and I think it was also he had some mutual funds in some of his portfolios that he liked. There's nothing wrong with that, but they paid out some capital gains at the end of the year. All of that went on his current tax return. And so I like to say the right hand didn't know what the left hand was doing. And because of the Roth conversion we did earlier, that had just added insult to injury, if you will, by pushing him much deeper into where we were comfortable with. Because the trade-off there, I mean, we always say in tax planning, is as much an art as it is a science sometimes. I jokingly say this, but it's a God honest truth. I once went through an entire analysis, and thank God the client was on Zoom, because when he saw the tax bill that we were modeling, he wanted to jump through that Zoom, that television and choke me. I physically sat back on the chair and had to tell them, Mr. Blah, 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 you don't have to do anything at all. But he just, I might as well have been wearing an IRS hat, go IRS or something like that. So that's where the art comes in. I don't expect anybody to be happy about prepaying taxes at all. But as you say, you're going to pay now or pay later.
Well, yeah, so you are going to pay taxes. It's either you pay them now or you pay them later. So ultimately, to that point of the story, kind of separate person there, but yeah, part of our job is to go through and, of course, we're modeling different tax strategies, and some of them are more aggressive than others, right? And then it's our job to kind of raise the trade-offs. And if you go this route, you're going to pay a lot more tax now, but here's the benefit that you're going to receive versus, okay, we can really, not be aggressive. We can pay a lot less tax now, but down the road, what this means for you, the trade-off is you're going to have a lot more taxes later, and the terms are going to be uncertain as far as what the rates are, what the thresholds for Medicare, Social Security. So that's also what you mean, Ed, by it's more of an art than a science, because we're working with incomplete information. So when you work with incomplete information, you have to make your best effort guess with the information that you do have. So just to kind of break down the story, though, that you said there, a couple things, a couple key points for you guys to take in. First, he said the right hand was not talking to the left hand. So in that sense, we're like the right hand. The client was managing some of his own money. He's the left hand. And he owned mutual funds, and he was doing some trading, which he thought was prudent. Absolutely. So making prudent decisions, what he assumed to rebalance the portfolio, take some gains at the end of the year. But the mutual fund component. Mutual funds pay distributions. So they pay capital gains. One of the downsides to owning mutual funds, one of the trade-offs, is that you can own the fund for many years and still pay capital gains tax every single year that you own the fund, because when the portfolio manager buys and sells throughout the year, those, if there's gains, they get passed through to you on an annual basis, and they go on your tax return, and they can mess up the tax plan. So you put a tax plan in place that had certain assumptions based on the knowledge that we had, the information that was available, but because of the mutual funds and their future unknown capital gain distributions and the trading he did at the end of the year, it created an incongruence between what we were planning and what we were expecting versus what the client did on their own.
And it comes down to timing as well, because we don't just meet with our clients in April or May, and that's it, the plan is set. We want to review along the way. Maybe they're still working, and all of a sudden, maybe in April of one particular year, they end up with a bonus because they're still working that we didn't know about in April. So we're meeting again maybe in September or October. I think with this particular case, we met in around October. The trades went off in December.
So Lizzie, I know you got a bunch of good ones, and I have a bunch of good ones for you, but I'm going to talk about kind of logistics of planning, because a lot of times we'll want to do Roth conversions earlier in the year if the market is down, let's say. Let's say we get a correction in the market, it's down 10, 15%, and we have a tax plan in place. We want to take advantage a lot of times of those depressed prices to convert shares at lower values and hoping that they rebound in the tax-free account. How do you personally handle this when you have a client that either has some held away money that you don't necessarily know what they're doing, you won't know until the end of the year, or they may have some type of other income coming later in the year that you're unaware of. So logistically, kind of how do you handle that process? What's that conversation like?
Great question, Troy. It's really just having open communications with clients. So are we anticipating additional income coming in later in the year? And if so, what is the range of that income expected? Based off of that assumption, I would say, you can kind of target, hey, it makes sense for us to target, $100,000 in a Roth conversion this year. Now, let's say we might have a bonus of $50,000 coming in later. Well, let's just do 50 right now, knowing that we'll reevaluate the plan and see if we need to do another 50 later on. Or if we get that big bonus, we didn't do all of that conversion up front beginning of the year and push us into a bigger tax bracket. We also see this a lot with clients that have concentrated risk. So, they worked for ExxonMobil, Home Depot, and if that, they possibly might want to sell some of that concentrated risk later in the year. If the price goes up, maybe we don't do the full Roth conversion in Q1. Maybe we do half of it and then push the other half out later in the year and just work with the variables within their plan.
That's an excellent point. It's an excellent point of competing priorities, right? So we call them competing priorities here, because if you have a large concentrated position of, let's say, Exxon, but you also want to pay less tax over time and you have this big retirement account, you have to decide between the two. Do I want to divest my Exxon stock so I lower my concentration risk, or do I want to tackle my long-term tax infestation in the retirement account? So those are two competing priorities that you have to prioritize. Which one am I going to address? And that's part of what we call here the retirement success system. It's going through a structured process that raises those trade-offs. It makes them visible so you, the client, can make better decisions about, one, understanding the interactions of those decisions, how they impact you not just today, but over the course of time. But then two, in the context of making the decision of which priority gets put first this year and which priority takes a back seat, because circumstances, dynamics, economics, whatever it might be, that one can take a back seat for now because it's more urgent to deal with this priority.
Yeah, absolutely. I just met with a client today. He's done very well for himself, has a good chunk of money in an IRA, but also worked for ExxonMobil for a long time, has a lot of shares in Exxon too, and traditionally we had been kind of prioritizing the Roth conversion, but with the ExxonMobil stock being trading at an all-time high.
Was it like 160 or something?
Yeah, it opened very high
55?
Today. I told him there's not a right or wrong answer. This is your money, but let's talk through what do we want to target this year, right? And time is kind of the essence because of where Exxon stock prices. Now, no one knows, is it going to go up from here or down from here? But we do know it's trading at a high, and you have a very concentrated risk. So what are we prioritizing this year? What makes the most sense? And it's not for your planner to decide. We have our recommendations, but it really comes down to, what you want to do with your money. But we just help kind of provide you the pros and cons, the trade-offs, as you said, Troy, and hopefully that provides you with enough context to make the decision that you feel is right for your plan.
Yeah, because life happens.
Exactly.
Right? Like going into this year, we had no idea that Exxon was going to shoot up to an all-time high, right? And we have a long-term plan in place for all clients, right? A short-term and an intermediate term, a long-term. But things change.
Yep.
Right? Things change. So now we have to anchor back to what's most important to you and really start to kind of decide which one of these objectives takes the front seat, which one of these are in the driver's seat for this year. And then if we change course because of these circumstances, what are the interactions, right? If we delay doing this decision and we do this one instead, what's the tax return going to look like? How does that impact the long-term goals? The timing element, if someone's closer to required minimum distribution age versus longer away, that can create an urgency with one priority versus others because the timing is now compressed.
Right.
So
Right.
this is why I do what I do, honestly. Like these types of conversations that we're having now, the planning decisions, and you too.
It's a puzzle every day.
Yeah, it is. You know, and Ed, I know it's the same for you as well. Okay, so we are going to just do a quick reminder here, and also a quick acknowledgement because I know so many of you tune in every single time we have one of these live streams, and we're very grateful. We really do appreciate you. So just kind of going through here, and apologize if I miss anyone. We have Scott from Pearland. Thank you very much, Scott, for being here. Definitely a long-time supporter. We have John, Scott. Sorry, little technical difficulties here. Dwayne, how are you? Good to see you again, Dwayne.
Yeah.
Where is Fast Eddie? Is Fast Eddie here?
I was about to ask, only because we have the same name.
Okay, so my little scroll bar here is a little frozen, so I don't want to hold us up too much more. But we're going to do a raffle. So if you're just tuning in, we're going to do a raffle in about 15 minutes where we have it's going to be a giveaway. We're going to give away a gift card to your favorite restaurant. In order to have the opportunity to participate in this giveaway, you need to download the Retirement Success Plan. So it's in the chat. You can either text us a number or click the link. And the Retirement Success Plan guide is actually really cool. So it's not just because it's a lot of content that I put together, but our marketing team did a really good job with it. So it's got a lot of videos in it, links to the YouTube channel and links to other content. And it does a really good job explaining what we consider to be the 5 tenets of retirement planning. So you have risk, you have income, you have taxes, you have healthcare, and you have estate. So the Retirement Success Planning Guide is very valuable if you are into learning more about retirement, how these different pieces coordinate with one another. So whether you're into the giveaway or not, it's worth your read for sure. And if you register for the giveaway, don't just register for the giveaway. Make sure to give the Retirement Success Plan Guide a read because there's a lot of good stuff in there. Okay, so I want to move to some IRA planning. Okay, so I'm going to give a brief story here because it really brings this point home, and you guys deal with it every single day with your clients. So many years ago, I had a couple come in, Gary and Susan, we'll call them, and we went through the process, and at the end of the process, we simply say, do you want our help? That's where we're at this point. Do you want our help? And Susan looked at Gary and she said, honey, I think we need to move forward. If something happens to you, I don't want to deal with this all on my own. So he smiled and turned and looked at me and said, Troy, appreciate everything you've done so far. We just need some time to think about this. So they went home, called me in a couple of days, and he said, Troy, I just can't give up control. He says, I'm going to call you in a few years. We'll deal with the estate planning. We'll deal with the tax planning. I just want to manage this for a few more years of my own. And then we'll put in place everything we talked about. I said, I understand. Yes, sir. Give me a call. We'll be here when you're ready. A few years goes by, don't hear from him. And then I come into the office one morning and she's here. And we go into the conference room and she started crying. She said, Troy, Gary passed away. So I said, okay, where are we at? What have we done? Tell me more. She tells me how big of a nightmare the past year has been, back and forth with financial institutions, filling paperwork out. She missed some deadlines, all this while grieving. It was horrible for her. And she said, Troy, where do we go from now? Where do we go from here, moving forward? So we looked at her situation. And most of you know that when one spouse passes away, you lose a Social Security check. But what's not common knowledge is oftentimes the brackets, well, always the brackets change, but oftentimes your taxes go up. So one of the things that we identify in a first visit or second visit with someone is what absolutely must go right. So Gary told me, he looked me in the eye and he said, Troy, he said, no matter what, I need to make sure Susan's taken care of. That was their what absolutely must go right statement. And they never got around to it. And so it's not just the decisions that you make sometimes that can lead to problems in retirement that cost you thousands of dollars. Sometimes it's the decisions that you don't make. So for them, their Social Security, one of them went away, so their income decreased, but everything else stayed the same. But their taxes, their income taxes doubled. So income down, but taxes doubling. Ed, tell us why.
She went from the joint tax bracket, married filing joint tax brackets, to filing single. And those are much more confiscatory. It's just that simple. It's easier to make the same amount of money and be pushed into a higher tax bracket. Some people call it the widow's penalty.
Yeah. And it's, Lizzie, it's not just the income tax brackets that compress, right? What else compresses?
Also, how much income you have to report through Social Security, RMDs, IRA distributions also impacts how much you'll be paying for Medicare, and how much of that Social Security benefit is taxable as well. So there's kind of multiple different dynamics going on here, not directly with taxes, but also with your Medicare costs and the taxability of Social Security.
So when we look at the overall situation, what you're ultimately saying is it's not just the income tax brackets that compress, it's the Medicare brackets that compress. It's the Social Security taxation thresholds that compress. And this compression, because you go from a married filer to a single filer, is what, if that's your go-to statement, meaning that's my number one priority, that's from the planning process, those are the big things that we're addressing first. So when we have decisions that we have to look at as life progresses, we're always going to anchor back. Mm-hmm. Okay, this is the thing that you said matters most. So when we need a guiding light, a shining light to help cut through some of the confusion, some of the uncertainty regarding, you know, should I do this priority? Should I do that priority? Should I pay tax now? Should I pay tax later? When you can anchor back to what is most important to you, that can provide a solid base to pull from to make that decision, and that's why we do that.
Yeah, absolutely. We face this a lot, I would say. You know, a lot of IRA assets are in one spouse's name, and maybe the RMDs are appropriate and would be okay. The required minimum distributions are appropriate and would be okay, assuming we both live a really long life, right? But the reality is, as much as we'd love to leave this world hand in hand with our spouse, typically one goes before the other. And now, you know, the RMDs are an issue because they're inherited by one person and under that single tax bracket. So it is a very common conversation that we have. Look, it's not absolutely vital to your plan to do Roth conversions, but if this were to happen in the future, it is going to save you on tax in the long run.
So Ed, how does that work? So just so we're clear, many of you won't benefit from Roth conversions, right, while you're living. Some of you will benefit when one spouse is gone. Some of you will benefit when both spouses are gone and your children will benefit. And many of you will both benefit while you're living. So there's multiple ways to look at this. And honestly, it's not been addressed in the financial industry to the extent that it probably deserves to be, because one simple way to look at it is Roth conversions create X amount of wealth for your family. Black and white equation, you should do it, you should not do it.
For about 85% of our clients, for about 85%, but not 100%.
No, because it really becomes a level of wealth question. But when you look at the risks large required minimum distributions pose and the potential for tax rates to be different in the future, it's an uncertain item. But more importantly, it's not just a lot of times the total wealth at some projected end of point time in the future that you have. It's the interactions that occur from having to take large required minimum distributions, that now maybe your Medicare premiums are higher, you are paying net investment income tax, you are now possibly, if you're doing those, you're definitely more of your Social Security is being taxed, and the introduction potentially of future taxes that don't currently exist in today's tax code.
True. Gosh, so many things that are moving in my mind right now when you say that, as far as which direction to go down. But, oh all I can say is tax planning also is also year by. That's another reason it's year by year. We get the question all the time. It happened to me with one of our colleagues here just last week, where a new client that came on board here was, give me my plan, as in, tell me what I'm going to be doing the next 35 years as far as everything that I plan. And I
You
know
didn't break out your crystal ball?
No, I didn't.
Aw.
But I will tell you a quick story. Because it just kind of dawned on me at that particular time, and this is not exactly to what you mentioned, but when it comes to tax planning, when it comes to ongoing planning, you make the best decisions with the information you have at the time. And as things change, well, then your plan will always pivot. But I remember, I don't know if he's watching tonight, but for, I think, his 6th year birthday, I bought my son a Lego Death Star. Now, where's this going?
I like it.
Okay. I had to look it up because it's, again, he's 21 now, but it is 9,000 pieces. So my first concern when I saw the box, which was not small, it looked like it contained one of those PC towers that he uses like for his gaming. Point being, I was like, okay, are there 9,000 pieces in this box? Turn it upside down? No, Lego did a fantastic job. They broke it down into individual bags. One was numbered, it was numbered or lettered, A or 1, what have you, and you would just focus on that first, priority 1. And then from there, once that was handled, it was on the radar, then you went to priority 2, then you went to priority 3, so it was much more organized. And so we get clients all the time that's like, hey, what they're in essence asking me when I hear that is I go back to that Death Star. And I'm like, okay, let's just open up every single one of these bags, put them back in the box, and then flip it on the floor. And then we'll sit there and hopefully, because there's your whole plan. So maybe it's not a perfect segue, but I just thought about that when it came to planning, IRA, required minimum distributions, making decisions now. You said it before in the past in the sense of, okay, you decided not to do anything short-term Roth conversions or any type of tax planning initially because of the tax liability. Okay, fine, makes complete sense. You're not pulling money from your investments to pay for those or pulling money from your liquid assets to pay for those tax bills. Okay, great. You get to a point, though, to where required minimum distribution is going to come, and now you're in a permanent situation if they're large enough, because it's safe to assume, no guarantees, that these assets will continue to grow. And if you're young enough, they could double.
Yep.
And then there is your snowball effect that we've been talking about this entire time. Higher required minimum distributions, higher IRMAA brackets.
I agree. Ed, the one thing too, I mean, just to give you guys kind of a context, I always tell folks I would rather take the tax liability now that we know what it's going to be than leave it to chance in the future. And we can always pivot the plan in the future. And a really good example of that is the tax code that was recently put into law in the last year, which included that enhanced senior benefit. So if you're over the age of 65, it is income adjusted, but you essentially could get an additional $12,000 deduction on top of your standard or itemized deduction. And for a lot of folks that are doing more moderate conversions, it really doesn't make sense for us to do a conversion that's going to put you out of the limit of getting that additional $12,000 deduction. Now, that law wasn't passed till about mid-year last year, I guess, but that was something that we had to pivot for a lot of our clients, right? There's no reason to do a higher conversion that's actually going to cost you more tax because we're limiting the availability of that enhanced senior benefit. I think it's just the value of a planner and value of working with a good firm is being able, like, let's plan what we can now, knowing that there's things down the road we won't be able to control, but at least we know the taxation of the account now, what we can convert to keep us in an appropriate bracket, and let's not risk future tax rates in the future, so to speak.
It's a balance. Again, it's raising the trade-offs of all of the decisions that we have to make and understanding the interactions of those decisions with one another and also with the tax code.
Right.
So what the story I brought up earlier about Gary and Susan, she didn't make any decisions. And this is what happens in life, right? A lot of times we make decisions and then the tax code pushes back. But a lot of times life makes decisions for us and the tax code still responds. So the question is, when you're in the position to be able to plan and make good decisions, Are you aware of all of the interactions that you need to make today, what they look like and what the consequences are, but also the things that you're not aware of, right? You know, it's one of the most powerful things, I think, that from a planning perspective that can be done. Okay, so we're going to get into some Social Security mistakes and planning discussions in just a minute, but we are at the giveaway point. So if you're not aware, if you're tuning in now, we're going to do one more giveaway at the end of this show. There is a link in the chat you can click on. There is also a phone number you can text in the chat. And we're doing a $100 gift card to your favorite restaurant. We're going to do one more of these at the end. And sometimes we go a little bit longer, past 7 o'clock for us Central Time, but only if we have, you know, plenty of people watching, good questions, good interactions, and there could be a one after that, but we're definitely going to do one more. So the winner of tonight's first giveaway is Ross McGregor. So Ross, congratulations! Thank you very much. You know what? You just reminded me. Do you guys remember the very first live streams that we did? Megan, if you're watching, hi. Megan's our marketing director. She would come out with the poppers.
Yes, I do remember.
Yeah. And I don't know if it was
yeah.
you or Ryan or Eric or Chad, but one of you were in the seat because we used to do it at the table right here, which is behind the camera. And she would come out with a popper. And it's the loud popper.
It is not, yeah.
Yeah. We weren't expecting this, and that was. We should do the poppers again sometime,
Should,
if not
yeah.
just
Confetti.
as a throwback for when we started doing these. Okay, so Ross, thank you very much for tuning in. Everyone else, you have an opportunity to win the next giveaway, which will be about 25-30 minutes from now. And if we're getting some good interaction towards the end of tonight's discussion, and we have some more people coming on, then we'll do another one. So, okay. So Social Security. I want to share a quick story before I throw it to you guys, because we could talk about Social Security, good decisions, bad decisions. We could do an entire live stream on Social Security. But, you know, many years ago, I had a gentleman come in, and he was 80, 81, 82 years old. And he came in because things were getting a little bit tough for him. He had taken Social Security at 62, and he said, Troy, back then, he's like, I wanted to protect my portfolio, right? He said, I didn't have a ton of savings, but I wanted to turn that income on. I always planned on it since I was, you know, a young person. I was going to retire at 62. Social Security was like my pension, and I thought it made a ton of sense because I didn't want to touch my savings. He said, but as time went on and I got older, he says the gap between my guaranteed income from Social Security and what I needed for everything else, it just continued to widen. And he said, what's happened now is I'm pulling, my fear has come true. He said, I'm pulling much more from my savings at this late age when I have no opportunity or no choice but to stick it out. I can't go back to work. I can't make any more money. And my healthcare expenses, they're increasing. My wife, her expenses are increasing. So we're in this position where we feel like we have this lower floor because our Social Security is small, and we're pulling so much from savings. So when we talk about Social Security, a lot of times, we always do in the context of a plan and what makes most sense for you. But Social Security is really a decision of where do you want the risk to lie for your personal plan. Do you want it to lie in the front end where you defer it? You wait until 67, 68, or 70, and you have to pull more money from your accounts, more money from the IRA, and deal with potentially sequence of returns risk, to deal with withdrawing money from the portfolio so you have less money to compound and earn interest on over the next 20 or 30 years. The risk lies if you defer Social Security more in the front end of your plan. Or do you take it soon and defer the risk to later, as in the story I just shared with you. So it's a lot more than a mathematical calculation of just where is your break-even point. And I think just for the theme of tonight's live stream, that's a big common mistake. I mean, that's probably one of the biggest, most common mistakes that I think we ever see as financial planners is I've done the break-even analysis, I have to live to 81 or 82, and I've taken Social Security early, or I've taken it later. if you don't take anything else away from this live stream, please take this away. That is the wrong way to look at Social Security. The right way to look at it, in our opinion, is how does Social Security fit in regard to what's most important to you? So, Lizzie, you know, how do you talk about Social Security decision making with clients?
Typically, most folks retire a couple years, if not 4 or 5, 6, possibly even from full retirement age or 70, and there's some type of mental connection with when I retire, I should start Social Security, so I have that income stream coming in. But when we sit down and look at the actual risk of the plan, right? You know, the first couple years of retirement typically tend to be what's called your sequence of returns risk, where if the market doesn't do well those first couple years, it can have a large impact on kind of the back half of your plan, right? So I think there's a lot of fear in not having that Social Security turned on, withdrawing more from your portfolio those first couple of years. But the way I like to tell people to look at it, and the way we like to build plans, in my opinion here at Oak Harvest, is creating different buckets to mitigate that sequence of returns risk. So, you know, having some cash set aside that could get us through a market downturn, or having another lever we can pull where we have some principal protected assets somewhere. The other thing I like to tell people is let's consider Social Security to be another lever we could pull in case we do face risk in the beginning of our plan. Now, with the market how it's been performing over the last couple of years, you know, those folks that did turn on Social Security early, you know, that may have been the wrong choice just because the market's been doing so well. You could have deferred that Social Security, which grows by 8% per year, which is also tax advantaged. Each year you delay Social Security, it grows by 8%. So I just like to tell people, you know, let's at least get you to full retirement age, knowing that if something happens in the market, we suffer, you know, an 08 or a 2020, the worst of the worst that could happen, we have that lever to pull where we could switch income stream from our investment assets to Social Security. But let's plan to delay it for now, and just year by year, we'll continue to reevaluate that decision. And I think that provides a little bit better context for people. Like, we don't have to take it now, but if we need to take it in case the market doesn't work in our favor, we have the option to, right?
Ed, any examples come to mind other than taking Social Security at the wrong time? What Lizzie discussed as far as some common mistakes or things that you see with Social Security?
Most of the conversations I have more along the lines of Social Security is exactly like you said. And I will use, pardon the pun, I will say that for right now, things are going well in the markets. I look at it holistically from, okay, you also have, and I'll use a simple example, 99% of your assets are in tax-deferred accounts. So by taking from your investments right now, we're starting to kind of add a headwind to those so they're not growing too much. We're not going to deplete them, but they're not growing as much. So now we have those more in line with thinking about future requirement distributions, even though it's way down the road. But yeah, I'll call it the trump card. Hey, if something happens between now, I'm not telling you to wait till 70. But at the same time, in the meantime, while things are going well, let's just kind of keep that aside. I often tell my clients I'm working with, Social Security, I heard it once, you know, just be 100% stocks and your Social Security is your bond portfolio. You can't liquidate your Social Security. But my point is that Social Security, if you want to just temporarily look at it like an investment, guaranteed income growth of 8% a year, guaranteed, that's pretty hard to beat.
Where do I sign up? No, I'm just kidding.
So that's another way I look at it. But then also, by delaying Social Security, assuming you have a large amount in tax-infested accounts, I don't want my clients adding more income to their 1040, so that way they can look at the potential for maximizing Roth
And I
conversions.
think that hits it on the head, in the sense that by delaying Social Security, we create a lot more planning room. We create a lot more Roth conversion runway.
Absolutely.
Right? We have more capital gains taking runway. Meaning if you have concentrated stock, if you have this portfolio I mean, we're in a period where the markets have done tremendously well for the past, call it 18 years, 19, 17 years, coming out of the 08 crisis. I mean, we haven't had many down years. I mean, we are in a really, really good long-term run. And quite honestly, historically, this is not normal. Now, we had 2022, where the market was down, stocks were down, bonds were down. 2020 seemed like a bad year during COVID, but the market finished substantially higher at the end of the year, but significant drawdown in mid-year. But, I mean, I'm thinking back, 2018 was basically a flat year where for the first time in history, every asset class was outperformed by cash on an inflation-adjusted basis. And I'm thinking back, 2012 kind of seems like it may have been a little bit of a bumpy year, but we've not had too many bad years, coming out of the crisis.
Yeah.
So a lot of times we can lose context as to what, normal returns in a long market cycle looks like. But
that also goes back to your investment plan. There's got to be congruence, as you say. Okay, well, I can take on more risk and take advantage of these great years. Well, hindsight's 2020. These have been great years in hindsight. At the same time, okay, we can go more conservative. I don't have as much growth, and God forbid you're going too conservative to where you're still losing money safely due to inflation and things like that, and taxes as well. But that's where the planning comes in. It's not just, here's a great investment, look at its past performance, and that's got to be the one for me.
Yeah. So the planning opportunities when it comes to capital gain, though, and dividends as well. So without getting into an in-depth tax conversation here, Social Security is taxed at ordinary income tax rates, but there are certain thresholds at which it becomes more taxable. IRA distributions taxed similarly at ordinary income tax rates. Your capital gains and dividends, they go on top of that income. So if you take Social Security, if you take IRA withdrawals, what you're doing is essentially kind of filling up the lower end of the tax brackets, which could lead to higher taxation or more taxation of your capital gains and dividends. Right now, if you're married filing jointly, you could have $90,000 to $100,000 of capital gains, long-term cap gains, and pay zero tax, right? So let's say you want to take Social Security, you're 63, just retired, but you have a decent amount of money saved up in a non-qualified account, so outside of your IRA. By taking Social Security, what you're doing is you're starting to fill up those lower ends of the brackets potentially, which could cause more of your cap gains and dividends to be taxable. And that comes back to raising the trade-offs, the interactions with the decisions that you make, how they interact with other decisions. So capital gains, Social Security. When do I take it? When do I sell? Those two decisions, whether you realize it or not, they interact with one another, right? They clash. And the tax code, it pushes back. Those two decisions interact with the tax code. Now, are you visibly aware? Can you visibly look and see, if I make this decision, this happens? But it impacts Social Security like this. In the tax code, it's going to respond like this. Those are the items that we're talking about, that when it comes to retirement planning, completely different from the accumulation phase. Because in the accumulation phase, paychecks fix everything, right? You can make a bad decision, you can make a bad investment, your income taxes were determined by the amount of your paycheck. In retirement, your decisions determine what your paycheck is. Your decisions determine how much tax you pay, and all those decisions interact with one another.
I could probably count many times where clients have said, we never would have been able to do the tax plan on our own. Even people who, have insight into how the tax code works, but when you start to juggle in all these different items, that's kind of a really nice compliment I get from clients is, wow, we just had no idea how all of these things interact, and I could never do this by myself. Even people who'd managed their assets for a long time when they were working, right? They just don't have necessarily the insight on how all those different factors are codependent on each other, essentially.
Well, I had a client many years ago. They made several very reasonable decisions within one tax year. So they wanted to do a kitchen renovation. They wanted to rebalance the portfolio because the stock market did really well. They wanted to do a Roth conversion. And they wanted to keep their RMDs down. So they were pulling income from the IRA. So they had these specific goals. where we wanted to keep RMDs down, we wanted to do Roth conversions to get money into the tax-free account to help the children. We wanted to do the kitchen remodel, and we wanted to rebalance the portfolio, be good stewards of the portfolio. So they never came to see us. He was an engineer, he was a self-manager, he was used to doing everything himself, very sophisticated, very capable, until they made these decisions without being aware of how they interacted with one another. And when he came in, he said, Troy, he said, the tax bill stopped me in my tracks. He says, I've listened to you on the radio for the past 10 years, coming back from my ranch in West Texas, and I've always nodded my head and I've agreed with you. And I was like, Troy's probably really helping other people. He's like, I never thought I would actually come and see you and sit down and you could help me. He says, but I made these decisions, and each one of them was in furtherance of a specific goal that I had. The Roth conversion, the kitchen remodel, helping the kids, paying less tax. Yeah. He says, I got my tax bill. Normally I was paying $7,000 or $8,000 a year in taxes, and my tax bill this year was $50,000. He says, I don't think you could have done anything, Troy. I think it just is what it is, but I want you to look at this. So we went through and looked at it. In a coordinated plan, we could have reduced his taxes from $50,000 to $900. Everything would have got done except the Roth conversion. And he did the Roth conversion in December. We could have simply waited until January 1st and he could have got the Roth conversion done. So it was the decisions of where he took his withdrawals from, where he took his living expenses from, the fact that he did the Roth conversion in the wrong year. He was trying to serve too many goals at once without seeing the interactions of those different decisions to serve those goals, how they interacted with one another, and then how the tax code was going to respond. Right. Because the tax code doesn't care that you served your goals, right? It does not care that you made decisions with respect to what's important to you. It just says, hey, look, this is what you did. This is what we say. And simple rearranging would have been a huge tax savings there, $49,000. Yeah. So when you say you bring that up, it kind of reminds me of that particular story. Mm-hmm. But I think that the biggest thing when it comes to what decisions people make that cost them a lot of money, whether it's Social Security that we talked about before. We're going to get into some estate planning things here in just a few minutes, but whether it's Roth conversions, whether they're right, it's the inability to raise the consequences, the decisions, the trade-offs of what you're doing that oftentimes leads to one of two things. Something that was pretty explicit and you just messed up, you just weren't aware. No. Or things that are not so easily visible that the tax code, it's not hidden, it's not obscure in any sense by definition, but you're not trained in it. Right?
You only know what you know.
Yeah.
You only know what you know. And we see that a lot when it comes to, we talked about this, Troy, a lot of times when we're sitting down with potentially new clients, usually they have had their own, as you call it, light bulb moment, and they're coming in the year after they hit required minimum distribution age because they got that call from their CPA saying, here's the tax bill for this particular year, because they haven't done anything. I like to say sometimes you can make a decision to do nothing. That in essence, well, you've made a decision. And I'm not saying it's a wrong decision, but in the short term, a lot of times I have to have conversations along the lines of, well, we can still look at, now they're very eager to do Roth conversions. I saw my first tax bill and oh my goodness, and they're only going to go up according to my CPA, assuming some variables continue to their trends. But now I want to do this, and it's like, okay, I'm not saying we can't help you, but it may not benefit you like you think. Are you charitably inclined? Okay, we can talk about it. Mm-hmm. Do you have family that your kids, if you will, that you're going to be leaving this money to? Is that important to leave them a larger inheritance that could be more beneficial to them on their tax side? But as far as you individually, yeah, I hate to say, respectfully, you've come in too late. I've had plenty of clients where they were on the fence, and I've had to tell them, okay, well, I'm going to think about it. Let me just leave you with one thing. And I did this with a client that came on board about less than a year ago. I said, please think about it. He was shopping around. I tell clients all the time, please shop around. I encourage you to shop around. I think what we do here is rather unique. Call me biased. Guilty as charged. But my point is, I said, your window of opportunity for this tax planning is this many years.
Yeah.
And tax code doesn't care. If you decide not to work with us, no harm, no foul. I'm going to sleep at night knowing that I've given you the best information and, yes, advice possible for you to make an educated decision. At the end of the day, yes, it's your retirement, it's your decision. But that does hurt my feelings when I'm like, oh, we could have helped you. Gosh, we could have helped you.
Because it's not just the fact that the income tax brackets are likely going to increase when a new administration comes in. It's the deductions, right? A lot of times the deductions change. So,
Yeah.
okay, so we are 10 minutes away from our next giveaway. So the giveaway is a $100 gift card to your favorite restaurant. In order to receive that, simply text the number in the chat or click the link to download our Retirement Success Plan guide. Pensions, Lizzie. So we were talking about this previously. Like, when you can have guaranteed lifetime income, it's a good thing. Social Security, a pension, it means that you have a floor of income that you cannot outlive. And as a planner, it is an extremely valuable resource because that's a rock, right? Like, I know if you have a pension and it is meeting 90% of your baseline needs, that 10% of the additional baseline plus discretionary, you have 600,000, 500,000, 2 million, 5 million. There's a lot of planning flexibility and creativity that can take place because we have that rock in place, that guaranteed lifetime income. And sometimes you can plan for that to happen later with like fixed annuities, or you can take a pension and Social Security now, those guaranteed lifetime income sources. A lot of ways you can do that. But Lizzie, we had someone come in not too long ago and they were excited about retirement. They wanted to do Roth conversions. They had this big retirement account. They wanted to do tax planning. They had all these things planned, but they had taken the pension. And they had, I think it was $60,000, $70,000 a year of pension, which is great for security, but I don't want to call it a mistake, but I want to call it making a decision without raising the trade-offs, without making the trade-offs of that decision visible. Talk to us about how that impacted the rest of the tax planning opportunities.
I think it's going to be very similar, Troy, to kind of what you were talking about, where applying for Social Security is really filling up those lower tax brackets first. So the pension election is typically an irreversible decision. So you're kind of going in blindly, not realizing that your decision is essentially taking you up potentially to the 22% bracket. It really leaves us with a limited amount of room in that tax bracket or the Medicare brackets to do Roth conversions, right? Not necessarily taking a pension is bad, but going into it without fully understanding the consequences, the pros and the cons, I think it would probably been much more prudent of this individual to meet with a certified financial planner to talk through, do we need this secure income based off your income needs to assets? Are there other things we should be considering, but then just electing the pension, an irreversible decision that will impact our tax plan forever.
It's a super great point, because here is someone who comes to what we call a heavy moment, right? You have to take the lump sum or the pension. Like, that's one of the heaviest choices that you'll have in retirement. And what we preach is you have to make the trade-offs visible. Excuse me. But in order to make the trade-offs visible and to make the right decision, I should say, we have to be able to anchor back to what's most important to you.
Right.
So let's walk through this, Ed. Let's say that same person comes in and they say, Troy, what's most important to me is to pay less tax over time so I preserve my accounts for my children, and I'm really weary of what tax rates might be in the future. That's why they want to pay less tax over time. Don't want to take a ton of risk. Want to have a go-go income plan, meaning I want to spend more when I'm younger, when I'm healthier, when I'm more active. Those are the things that are most important. But if we said, what's the one thing that must go right, in your retirement? And let's say they say, well, I don't want to be in a position where I don't have flexibility, right? I want to retain control. Okay, that same person comes in prior to having made that decision about the pension, what does that conversation look like when it comes to, should I take the lump sum or should I take the pension?
Well, in a nutshell, you said control. Pensions are great. I mean, guaranteed income, that's going to, if you will, complement your Social Security. Once you turn it on, the flexibility goes away. You do joint life like a majority of people, then great. It's going to be paying as long as you and your spouse are alive. However, there is no cost of living adjustment, generally speaking. That's fixed. The decision is fixed.
What about the second goal there? So let's say the second one was, I want to pay less tax over time.
That's the opportunity that they're giving up. So in exchange for all of this security, which there's nothing wrong with that security, but if the goal is I want to pay less tax over time, taking the lump sum, rolling that over to an IRA, provides more flexibility to potentially maybe still, and I'm not giving advice here, maybe still look at some type of annuity where they can still have some guaranteed income for down the road, but in the meantime, start maybe converting those assets to tax-free in a strategic way.
So what I'm getting at here and what Ed has articulated is you have a heavy moment, you have a heavy decision, and you make it because you're like, I want the pension, I want the guaranteed income, I want to feel secure, but you're not recognizing your other priorities and then having the trade-offs made visible in regards to what that decision means to everything else in your retirement and other things that are very important to you. So by taking the pension, in this particular example, you've created inflexibility when it comes to tax planning. So your number one goal, let's say, or one or two, was not to be cornered, not to be in a bad position, but to maintain security. And then let's say number two was to pay less tax over time. Well, those are, again, what we call competing priorities, right? Like if we have this heavy moment where we have to make this decision about the pension, we have to decide which one's most important. Having lifetime income security or paying less tax over time. Because if we take that pension as opposed to the lump sum, we're ultimately saying that having lifetime income is more important than tax planning. Because that pension is going to fill up the bottom buckets of the tax code, which will limit the ability, or at least make it more expensive, to do any type of tax planning for the rest of your life. Because that income is permanent. It's going to be there always. So it's not, and I love the way that you said it's not right or wrong.
No, it's not right or wrong.
None of these decisions, a lot of times, for the most part, are right or wrong in retirement. It just depends what's important to you. How does this decision interact with other decisions that you'll have to make? And how do they all re-anchor back to what's most important to you? And then what is the order of importance of those objectives? And then once you create clarity and visibility and have a structured way to have those discussions, raise those trade-offs, the decision-making process becomes a little bit easier. So Lizzie, how would you, not how would you handle it, but what are some other maybe observations that you have in that particular situation where if somebody takes a pension and they want to pay less tax over time, but they also want security and they have a lot of money in a retirement account, and they want to take care of the kids. Those are a lot of priorities, and honestly, they do all compete with one another often.
I would also just bring up one other point. We're talking about kind of the pension decision, almost trapping them into having limited tax flexibility. I actually would argue, too, that it's trapping them into having a limited income plan, too. Where if we kind of have that lump sum assets coming in, we can start to diversify and create different buckets of risk, different buckets that will provide you income as well. So I just thought I would add that. But kind of like Ed said, there's not necessarily a right or wrong answer, but I think the most important thing is just providing clarity around, what makes most sense for you, right? We have this goal and objective. What decisions can we make to meet that? And what decisions, how does that decision impact the other facets of our entire retirement plan as well?
Everything interacts.
Exactly. I don't know if I answered your question, but.
No, that's good. Okay, so I normally, I'm going to mispronounce this. Lizzie, the Cornelios here?
Oh, okay.
Yeah.
Hi guys, how are you doing? I think I meet with you in a couple weeks. Can't wait to see you.
So one of the things I normally do in these live streams is I ask to make it interactive. And so I did not do that tonight, but guys, if you have questions, we're talking about a lot of really good content here. And while we can't give personal advice, we can take the content of your question and extrapolate that into a conversation about the general idea or the general context of it. So if you do have anything there, please type it in. We are at the couple minute mark before we do our last giveaway. We have a couple pre-submitted questions that I want to get to because they bring some really, really good points up. One of them definitely, the other one we'll just address. So it seems like we're going good. We'll probably go for another 15 minutes or so here. But if you have questions, go ahead and put them in now. Again, I have Ed, Mr. Alper, how you doing?
Hey, Ed.
So Ed says, no, I learned very quickly that Ed Rossi will help you avoid those surprises. But Ed Rossi is also a very weird and ugly individual.
Thanks, Ed.
No, I'm just kidding. You didn't say that.
We're gonna have a call. I was about to have a call with Ed tomorrow. Tell Olga I said hello. Hopefully she's watching as well.
Yes, Olga, how are you? Hopefully you're watching also. Okay, so let me reset. If you have any questions, we want to make this interactive. We have about 15 minutes. Please enter them now. We'll do our best. If not, we have some content that we'll continue with. 1 minute. We're going to do the next giveaway. So within that minute, I'm going to give Lizzie and Ed an opportunity to anything that's kind of on the back of the brain there that maybe you want to add in or discuss from what we've been going through. Give you an opportunity to bring it up.
I will often say when we're talking about, particularly when it comes to tax planning, which is very closely interrelated to income planning. One thing, if you take anything away from this, is we always talk about as planners, investment advisors, you want to diversify. So much in this bucket, stocks, long-term, short-term, bonds, whatever the tool may be. But then you also want to diversify from a tax perspective as well. How much do you have in tax? Because it's real simple. The IRS, you got tax-free, you got tax-deferred, and you got taxable. And so make sure that you're diversified along those lines, because from the income planning side of things, we can pull from multiple buckets there. And then also, as planners, I like to, particularly with newer clients, I'll point out the fact that where do you want your, I can't wait to hear what somebody said to you just now.
No, Ed, sorry. Ed just said watch it, Troy.
Ed is watching.
Yeah, and Michelle and Mark were really nice to me compared to your clients.
Yeah, Mike, we have some good conversations, but it's all in fun. But it's another way to make it. If you think about it, if we're able to position you, and we don't know what tax rates are going to do. The overall sentiment is that they'll be higher in the future. Again, we don't know. There's no guarantees. Maybe they'll go up and they'll go back down. We don't know. We will adjust as necessary. But if you can put yourself in a position, assuming it benefits you, to pay less tax, is that not like a return? Maybe not from a stock, not from a bond, but from the IRS.
Yeah, absolutely.
Yeah.
I'll just add one quick comment. I think probably what brings me the most joy in my professional career, and Ed, you probably feel the same way, is people come in very overwhelmed. Oops, sorry, I just said this mic. People come in very overwhelmed. They know that they have all of these competing priorities, all of these different goals and objectives they want to meet. And personally, what I find most rewarding about what I do is just adding clarity to the plan and saying, like, slow down, let's take it piece by piece. And just ensuring that folks understand what decisions they need to make and either the consequences of those decisions or the benefits of those decisions. And just having the tools, I guess, to walk people through that and being able to work with people is incredibly rewarding. So just part of why I do what I do, but it's also really fun to interact with clients and get them from, oh my gosh, I'm so overwhelmed, to I feel at peace, I'm going to go enjoy my retirement now.
One bag of the Death Star at a time.
So I've always called it the light bulb moment.
Yeah.
And that's what it is.
Yeah.
Okay, guys, so we're still doing good here. We have a lot of people on, so we're going to do one more giveaway. We're going to go for about 15 more minutes because I want to talk about long-term care and estate planning, because these are two areas where I think costly decisions are often made. But of course, before we do that, we have our second giveaway winner. But we're still going to do one more giveaway winner. We're going to do that. I have 7:04 my time here, so 7:20 is 15 minutes, 16 minutes. we're going to do the last one, and then we'll wrap it up and we'll call it a night. So the second giveaway winner is Ram Subranium. Subranium. I think that's probably more accurate.
Yay, congratulations.
So congratulations, Popper.
Yeah.
So Ram, congratulations. We thank you very much for tuning in. I appreciate your support, and everyone else. So now we're going to do one more. I told you if we have a good viewership and some good participation, then we'll continue this, and we're going to do so for about 15 more minutes because we have 2 more topics that we really wanted to get to that we didn't have the opportunity to. So estate planning. So what happens, Ed, when someone keeps telling themselves, you know what, I need to get that will done, I need to get that trust done, I need to get these documents done, but a lot of times what gets overlooked is possibly the durable power of attorney. So first explain what that is, and we're not giving legal advice, we're not attorneys, but we're planners and we deal with this all the time. And what are some of the mistakes, what are some of the scenarios that could go wrong?
Oh goodness. First, I'll run into what I run in more often, and that is particularly at the beginning of a relationship, I will ask, where do you stand with any of your estate documents? And the first response is, oh, we have a will, and there's almost a feeling of, and so we've got that box checked. And maybe they do. But a lot of times I will come back with, okay, but what about powers of attorney? That, at most of the time when you're in your 50s or in your 60s, I'm more worried about that happening to where you can't make a decision for yourself than you passing away. And so from estate planning side of things, powers of attorney are huge. I mean, it makes things, estate planning bottom line doesn't benefit you as an individual. It benefits survivors. It benefits those that
You love.
I mean, it's not something fun to talk about. We're talking about, I try to do it in jest, but every time I'm talking estate planning, I always, and Ed, you might hear, I'm going to go back to Ed. We're talking about estate planning. Okay, Ed, I'm going to have to kill you a lot today because it just seems rude not to not kill the wife. It just seems rude. I think, Olga, now you're, so, but, yeah, I'm worried about Ed not being able to make decisions for himself. And those decisions can be financial. They can be medical. They can be, do I want to be left to nature and just made comfortable, or do I want the doctors to use Herculean efforts to keep me alive?
Well, some of the bigger ones, though, that to focus on here, the financial ones, right? Like we've had situations in the past to where people did not have these powers of attorney in place, financial ones, and the husband becomes incapacitated, and he has all the money in the retirement account, in his individual retirement account. There's a reason why you have that individual, the IRA. It's not a joint retirement account. Even though you're married, it's an individual retirement account. So the husband has all of this money from the 401k that's rolled into the IRA. 75, 79, 84 years old, they become incapacitated. Their medical bills, there are specialists, there are things Medicare doesn't cover. And then the wife goes to X company and says, you know what, I need to pull out $400,000. This is what we're going to do. Ma'am, you can't do that.
Yeah, we need to talk to your husband.
But you can't talk to my husband.
We understand.
But I need this money to take care of him.
We need to talk to your husband. And then the next question was, who has power of attorney?
My attorney's going to call you.
Okay. Okay. Do they have power of attorney? We can go round and round all day long.
What is wrong with you?
I'm just another person at the end of this phone at an 800. Don't get me started.
But that's how it goes. You know, that's how it goes. So you have all this money. You have all this money planned for retirement, but you didn't make the decision to deal with your powers of attorney. And Lizzie, I know throughout your career, you've seen this multiple times. It's something we deal with as part of our structured process, but we can only show the horse where the water is. We cannot make the horse drink. And so many times in this world, you have CPAs that operate in their silo, the attorneys that operate in their silo, the investment advisors that operate in their silo. No one's overseeing and coordinating that entire picture. And this is one of those areas that often gets overlooked. So what do you recommend or have you seen from this?
There's typically some pushback from clients on, oh gosh, it's so expensive to get it set up. But Chris Paris actually emailed me based off a conversation we had a couple days ago. the majority of the wealth in this country is with older folks right now, point in time, and the amount of financial scamming and financial crimes that is taking place against the population 65 and older is very alarming, right? And what can we do? What can we put in place in order to protect you? And that's somebody who can step in and make financial decisions on your behalf if you become mentally incapacitated. It's not a fun thing to think about. I know even some advisors here have had mother-in-laws, father-in-laws have an outside investment advisor try to put them in inappropriate funds, or, and, even those type of things scare me for my own parents, to the point where I called them like, hey, we need to get this prioritized for you, right? Having a safeguard in place that's going to protect you when maybe you're not of sound mind. It's not only going to protect your assets, but it's going to protect your legacy to your spouse. It's going to protect your legacy to your kids, right? So it's not a fun or sexy part of planning, I would say, but it is essential to a full financial plan.
We have a couple good comments here, but before that, just to add to your point, Lizzie, that oftentimes you can have two completely mentally capable people today.
Right.
6 months from now, one of you may not be.
Yep, absolutely.
Now, I'm not saying this like if talking to you if you're 52, but if you're 73, 75, 81, 84, sometimes it goes quick.
Yep, absolutely.
And given that the husband sometimes is older, this is typically what we might see. What happens if all of that money is in your husband's name and he's making bad decisions? He has complete power, complete control, if it's all in his retirement account, individual retirement account. These are the types of decisions that oftentimes get overlooked. These are the planning components that need to be addressed. Everything seems fine now, but things change. You put protections for your family in place, so if they do, you're protected. And we hope they never do. But these are really good examples of how things can go wrong and how they can be easily overlooked and how we need to address them.
Yeah, I always tell people too, we can control what we can control now, so let's get something in place, knowing that if
Just do
something
it.
does happen,
Just do it.
Yeah, just do it.
Just do it.
Do it while,
Nike.
Yeah, exactly. But have
Nike's
something
made
in
billions
place.
of dollars off this. Like, let's save you a few $100,000. Okay, Paul.
Absolutely.
Good to see you, Paul. Paul says, quick question. If we have a detailed trust, do we still need a will? So, I'm not an attorney. I'm not giving legal advice, but yes. Ultimately, most attorneys would tell you you still need a will because the trust takes care of assets that you place inside of it. A will handle everything else. Let's keep it at its most basic sense. Your trust may transfer all of your assets, like your home, your investment accounts, certain things. But what about your couch? What about your wife's jewelry? What about things that do not have a title necessarily that you can put into a trust? And also, it's just instructions for a judge to handle the disposition of your estate for everything that kind of flows through, that wanders down to the probate level. So yes,
Cars
most
as well are a
attorneys
big
would tell
one
you
too.
that.
Yep.
Yeah. Now, house and cars, you can put those things in the trust. Different states have different rules. You have property tax. You have different exemptions. You have things that become more complicated. So talk to an attorney about it.
Yeah.
But the simple answer, Paul, is yes. You do need a will. If for no other reason than to address everything that falls through the trust, and trust me, there will be things that fall through. So the court isn't making decisions for you. You have something on record as to what you would like to transpire. So good question there. Ed brings back something which I wish we could all have, which is an attorney and a doctor in the family. I'll tell you this. My wife's sister is a nurse, and my wife's grandmother is in Central Texas, and she's going through a circumstance right now. And yes, having her sister there to help absolutely impacts it. And I got to be careful because this is personal to me, given what I went through with my grandparents. But it absolutely does help Ed to have a family and attorney in the family here. Okay, so what is the best way? Mary says, what is the best way to calculate future IRMAA brackets? Oh, Mary, if you find this out, please let me know.
We're hiring.
Yeah, the government can't even explain to you how they're going to calculate future IRMAA brackets. So from a planner's perspective, this is something that's frustrating. I have researched this no less than 10 times, and there is no straight formula of how they're going to calculate future IRMAA brackets. So I don't know if you guys have anything to add to that, but
I will only say that we once were doing an analysis with a client, me and my colleague Chad, and we do so many of these that you start to every year slowly but surely memorize the certain thresholds. And between one week and another, those thresholds actually went down.
yeah.
And we were like, wait a minute. So we actually called some resources and saying, hey, we couldn't help but notice this. And their response was, yeah, the government recently overestimated the cost of a particular medicine that's that's widely used for those that are on Medicare. And because of that, they actually brought it down. And so my response to the client was, hey, this is great for this year. Was it huge? No, but it was still a step that we were not used to seeing.
Not expecting.
Not at all. And so I tell clients all the time, we always expect it to continue to increase, a cost of living adjustment, if you want to call it that. But yeah, that's the only thing that comes to mind with that. But we have to depend on.
Well, the frustrating
tools we
thing
have.
too is it's typically not published until very end of the year.
Yeah.
Right? So it just doesn't give you much
Sure.
leeway. You have all this time to hem and haw about what it's going to be, but the certainty really isn't provided
That's
until
why
end of the year.
whenever I'm running these analysis for my clients, I will always put what I affectionately call a buffer in.
Yeah.
Here's the next threshold. Again, we're dealing with a lot of estimates right here. Maybe we're going to go back to an hour ago. Maybe you're still managing assets on your own. Maybe you got some mutual funds in a taxable account, which I don't like. That's another subject for another time. But my point to the story is, okay, so if this is the number, $100,000 Roth conversion, I'm just pulling that number out of the air. Let's do a $90,000 Roth conversion, maybe an 85. So if we
I
miss
agree.
something,
Yep.
we're not hitting.
Create some space.
Just give
Yeah.
some space, just in case.
Yep.
And I believe this past year, I believe the Part B threshold increased 9% and the Part D 6%. So Medicare, and I'm not going to go down this rabbit hole, but it is something worth knowing that Medicare is in more dire financial straits than Social Security. Multiple reasons for that, but the easiest way to understand this is approximately 10,000 people every day start taking Medicare. Tomorrow, 10,000 people are going to sign up for Medicare. The next day, the next day, the next day. This is going to happen for many more years. And then last estimates I saw is once 10,000 people a day, once that stops, it reduces to about 8,000 people a day. So we have a tremendous pull on the system as far as the demand for services, and we have a static FICA system which funds Medicare. So it's in bad shape, and those are the thresholds that you have two components here, right? The Medicare premiums themselves, the Part B and Part D premiums, they're increasing at substantial rates. But the more punitive aspects, which are the, for many of you watching, more, the IRMAA thresholds, they're also increasing. So we have two. It's not just the rate of growth; it's the rate of growth, which we're bringing up calculus now, which is the third derivative, but it's substantial and it's a concern. Okay, so long-term care. I want to bring up long-term care, and we have a couple minutes. So let's do this. So let's go ahead and get the giveaway ready so we can give that out so I can keep everyone on time. And then as we do this, I'm going to continue with this long-term care story. Those of you that need to go, I understand you need to go. Those of you who want to stay and listen to this, we can do it. So Mike Davis. So Mike Davis, you are the winner of our third giveaway. It's a bonus third giveaway. We don't typically do this. So Mike, I hope you pick a really good restaurant and take this gift card and apply it to it. So we do these once a month, guys. So if you did not win tonight, you have an opportunity to win next month. But hopefully you don't tune in for the giveaways. You tune in because we give you good content. So my grandfather, 3 years, over $1 million of healthcare costs, close to $2 million. A lot of that was long-term care. It shaped every decision I made with this company from the foundation, right? We're going to be a planning company because he lacked people to help raise awareness of the interactions of the decisions that he was or was not making. Some people didn't even raise decisions that needed to be made. So there was a guy named Arthur, and this was 2012, 2013 maybe. He called in from the radio show, and he said, Troy, I'm 87 years old. He says, you can't help me. He says, but I want to come see you. So I said, okay, yes, sir. He comes in to see me, and I'll never forget. We sat there, and you remember those old tweed jackets, right? He pulls in, he goes into his pocket, he pulls out this notice. It's from the long-term care company. And it says, your long-term care premiums are increasing 100%. So, yes, sir, I've seen that before. He says, Troy, this is the 3rd year I've received this notice. I had not seen that before. He says, if I get sick, they're going to give me $36,000. But to keep this policy in force, I have to write a check for 30 grand. And I told you can't help me. Now prove me wrong. I said, no, sir, I can't help you. That's just what it costs. He says, I pray to God every single night that he just takes me. He says, but I'm healthy as a horse, and I'm just going to keep going. He says, I have no choice but to let it go. So Arthur is an example of somebody who made thousands, tens of thousands of dollars of investments into a policy, but didn't have anyone there to raise the awareness, the trade-offs. If you keep paying into this policy, this is what will happen at age 85, 86, 87.
No.
So long-term care is one of those things, Lizzie, we have an advisory meeting every Monday morning, and Lizzie brought up a really, really good point. I don't know if you even remember, a month or two, probably 3 months ago, where you were having a conversation with someone and you were discussing the trade-offs of actually allocating funds to long-term care now for somebody who's so young, but they have that, this is what I want to do. I want to make sure that long-term care is taken care of.
Right.
But even though that's the case, you may be able to create a hybrid strategy where we self-insure for a large part of that because you're so young.
Yep.
Tell us about that.
Yeah, well, exactly what Troy said. I mean, the issue with the traditional long-term care policies, almost kind of think of it like an auto policy, right? An insurance policy where you pay it every month, and you really don't get a cash in on that investment unless you actually need it, right? And it's really not an investment because you're not typically getting all the money back that you put in. So what we really try to do is sit down and come up with some different creative strategies where, hey, even if I don't use this policy, or even if I don't use this bucket that I'm investing into for long-term care, at least it goes to my heirs, or at least I can use it later on in life. Commonly called asset-based policies or asset-based strategies. But I've seen it a lot with my clients too. You know, they buy into these pretty phenomenal long-term care policies when they're 45 or 50. And then when they turn 80 or 85 and they get closer to actually needing to use the policies, number one, they've invested so much money into this. Number two, they just continue to raise those premiums because you're more costly to insure. You're more closer to needing the funds. So what we really try to do here at Oak Harvest is provide you with what other methods can we get to alleviate this priority, this concern in your retirement plan, and is that a better decision for you and your financial place than kind of those traditional long-term care policies?
Yeah, let's look at all of it, right?
Right.
For a lot of people, self-insuring makes a lot of sense.
Mm-hmm.
For some people, traditional long-term care makes a lot of sense.
Yeah, absolutely.
And then you have new hybrid strategies that are available that could also make sense.
Yep.
But you can also do a combination. You don't have to choose one.
Right,
right?
exactly.
So, but you need to understand, not just in the moment of decision, in the planning discussion, what you're going to do, it needs to be revisited, right? On an ongoing basis, because if someone would have been there for Arthur when he turned 69, 70, someone could have said, hey, Arthur, you know what's going to happen? Right now, your premiums are $400 a month.
Yep.
$350, $600, whatever they were. When you hit 80, it's going to be pretty expensive.
Yeah.
You know, Arthur had paid tens of thousands of dollars from the time he was 80 to he got that notice. 3 years in a row, they double. No one was there. Nobody was there. You have to be aware of the decisions that you're making, the consequences that they have, and they have to be looked at consistently.
Yep, absolutely.
Ed, before we shut this down tonight, long-term care, observations, discussions, or anything else you want, complete free card here.
How much time do you have? No. I'll elaborate on one thing from that story that comes to my mind every time. And everybody's got to make a living. I'm not putting that down. But what you described to me, and I never met Arthur personally, was back when he did purchase that long-term care policy, the relationship he had with the person that showed it to him, sold it to him, however you want to describe it, was transactional.
Absolutely.
Yeah.
And there's nothing wrong with that.
Probably never saw him after that,
Never saw
that
him after
application was signed.
Correct. Versus when you're working with a holistic planner, yes, it's still an insurance product. Insurance, you're dealing with commissions. So for some people, that's a proverbial four-letter word, but it's tied. The decision is not made in a silo.
Right.
I use the example often when I'm talking to my clients of, okay, what's the difference between working with a broker? I'm not putting down brokers or anything like that. What's the difference though? And that is, okay, imagine if you go and you ask someone, hey, I go to a car dealership and you want to buy a sports car. A car dealer's going to ask you what color. That's about as far as transaction's going to get. Versus a planner, planner in theory would be like, okay, well, what do you want to use this for? Well, I've got a family of 6 kids and I want to be able to go fast and I want to do this. Okay, well, Corvette probably won't get you there.
So the planner would not recommend the Lamborghini.
No, he would not recommend it, but he might recommend one of those SUVs that I saw in the video that can spin all 4 of its wheels. You can put all 6 kids in there and still have the 800 horsepower.
If the planner did, though, that would be some pretty good ammunition to take back to the wife. Honey,
My planner told me
they
I
said
could do
it's
it.
okay if I buy the Corvette.
Corvette, yes.
That's a quick way to piss off the wife.
Yeah, exactly. Well, more often than not, I'm upsetting the husband, and then it is, because we say it all the time in our meetings, very often, and I know it's off topic, but very often we're having to tell clients because of the ongoing planning, hey, you've been in retirement for such and such years, hindsight being 20/20, the market's been doing well, you can spend more money. And I get almost the snarl from the husband, will you shut up? And I get the smile from the wife. Really?
We support Amazon enough at this
yeah,
house.
exactly. But that's my only. I often say, I'll say this when it comes to, because of the competing priorities. Very rarely, and we have stories to where that was just plainly a bad decision. In the sense of it's going to maybe put your retirement in jeopardy. Well, maybe not, but at the same time, it's not the best use of your funds. I jokingly say IRS is going to send you a Christmas card this year if they did that. But at the same time, sometimes the choices just come down to, yes, I'm happy to say it's not a choice of right or wrong. It's a choice of good or better.
Right.
And it just comes down to that. And that's what brings me joy.
It's never right or wrong. The less money you have, the more consequential the decision becomes over the long term.
Right.
But it's not about right or wrong. It's about what is the best decision in the moment.
Mm-hmm.
So if we have brought to your attention interactions, not just with one another in regards to the decisions that you have to make, but the tax code itself, and you want to discuss your situation, you can always reach out to us. There's plenty of ways you can figure that out. But we are here to help, and we can help make these visible for you and help you make better decisions. If you're a client, I want to thank you so much for tuning in and just being here to support us. Honestly, without you, we'd probably have 2 people watching, so thank you very much. And I want to give a special thanks to everyone behind the scenes who came together and made this work without Eric tonight. And Eric, if you're watching, we miss you, and we can't wait to see you next month. Take care of that back. And thank you guys very much, and we will see you next time.